I've been investing my money completely by myself using a DIY or do-it-yourself approach for exactly 1 year now. Up until this year, I'd been using a Robo-Advisor to invest, and I'd stuck with that approach for 3 full years. But after realizing that I'd built up the confidence to invest on my own and that I could bring down the fees that I was paying substantially by investing on my own, I realized that it was time to change from a robo-advisor or managed investing to DIY or self-directed investing. So at the beginning of this year, I shut down my managed account, sold off all of my investments, and then transferred my money to a self-directed account instead. Then I reinvested my money in a new ETF that I selected myself because I was now DIY investing and I had to make those decisions and those purchases myself. So in this video, I'm gonna talk more about that process, how it went, what I would do differently now in hindsight, and of course, I'm gonna share the results of my portfolio so far, including how much money I've made or lost. So let's jump into it. Now, like I said, I used to invest using a robo-advisor, and I specifically used Wealthsimple's Robo-Advisor, which is also called their managed investing option. Now, a robo-advisor actually invests for you. So you just have to sign up, pick your risk level, and then you add money into your investment account. And then whenever you do that, they basically have an algorithm that'll actually choose your investments, purchase them for you, and then also rebalance them consistently. So I stopped using that, and now I use Wealthsimple's self-directed investing option instead, and I take a DIY approach. Now, a DIY approach means that you actually have to choose and purchase investments yourself. So on top of setting up your account and then adding money into your investment account, you also have to decide exactly what investments that you want to purchase and then actually do the purchasing yourself. Now, back at the beginning of the year, I'd only ever used my TFSA, so my tax-free savings account, to invest inside of. So basically, Wealthsimple was my investment platform, my TFSA was my investment account, and then the Robo-Advisor invested in multiple ETFs as my investment options inside of that account. Now, instead, I'd still be using Wealthsimple as my investment platform, I'd still be using my TFSA as my investment account, but I had to choose what my new investment options would be. Now, I actually decided not to invest in the same ETFs that the Robo-Advisor was, mostly because I wanted a more simple option. Now, the Robo-Advisor had me investing before this in 6 different ETFs, but because I was gonna be doing it on my own now, I didn't really wanna have to purchase 6 individual ETFs every single month, figure out how much of each one that I wanted to buy, do all the work of rebalancing all the time. That just felt like a lot of work. And beyond it being a lot of work, all of that also leads to potential mistakes that you can make as well, which would impact your overall return. So instead of doing all of that, I took some time to figure out what I wanted to do, and what I landed on was investing in an all-in-one ETF instead. Now, an all-in-one ETF is basically multiple different ETFs that are all like packaged together for you into one overarching ETF that has all of those other ones inside of it. Basically what this does is keeps it really simple. You just have to purchase one ETF on your own. Now, all-in-one ETFs are great for what I just mentioned, which is keeping things simple. There's a lot of simplicity with them. They also give you great diversification too, because you're investing in multiple different ETFs inside of it, but they also do come with a slightly higher fee, so that's the trade-off for them. Anyways, after a lot of deliberation, research, figuring out what would make the most sense for me, I figured that I was okay with that trade-off and I wanted to go with an all-in-one ETF. Now, the all-in-one ETF that I chose is called XEQT. It's an all-equity ETF, which means that it's made up of 100% stocks, and it's also globally diversified, so it tracks the US market, the Canadian market, international markets, and also emerging markets as well. Now, before we get into that, I'm here to remind you that we actually have a brand new investing course called Simple Investing for Canadians. This course covers everything that you need to know in order to start investing in the stock market the simple way. We focus on passive, long-term investing using a self-directed approach. There's hours of video content, you get a bunch of downloadable resources, you get a personalized investing game plan, and you get to be part of our private community too. You can find more information and the link to sign up down in the description box below. Now, you can actually sign up now, and then the course content itself is going to be available on January 15th. Now, let's get back into my investment portfolio results. So after selling off my investments from the Robo-Advisor and transferring my TFSA from a managed account to a self-directed account, I now had about $50,000 in cash sitting inside of my TFSA that I was going to use to purchase shares of XEQT instead. Now, I decided that I wanted to use a dollar cost averaging approach to do this, which basically meant that I was going to spread my purchases out over a few months instead of reinvesting all my money at the same time, which would be a lump sum investing approach. Now, the reason I wanted to do this was mostly just that I was feeling kind of nervous at the time of investing literally $50,000 all into just one single purchase, one ETF that I was new to. Now, this was for no real reason other than it was just what I was feeling at the time. I guess how you feel, it can't really be right or wrong, although I'll talk about this more in a second. But at the time, I don't think I'd ever bought something for $50,000 all at once. Actually, I know I hadn't. So it just felt a little bit overwhelming. So my plan was to purchase $10,000 of XEQT per month for 5 months until all of my $50,000 was reinvested instead. Now, on top of that, I was also going to add $2,000 per month into my TFSA. Now, that's just my regular monthly investment contribution. That was my goal for last year, was to invest $2,000 a month. So basically what that meant is that I'd end up purchasing $12,000 of XEQT inside of my TFSA every month. So that's exactly what I did for a few months until I actually ended up learning that lump sum investing is better than dollar cost averaging the majority of the time. Basically, dollar cost averaging is fine for your monthly investing. So every month when I make money, I'm going to continue to split it up between my expenses and then having some go towards my investments. But when you have a lump sum to invest, like I did in this situation, it's actually most likely statistically to have a better long-term result if you invest it all right at once. So with that being said, I actually ended up lump sum investing the final $25,000 or so in March. Now for me, I feel like it was a combination of obviously learning this. It was a statistics-based approach. So obviously that helped. But on top of that, I'd also been starting to purchase XEQT for a few months. So I was more comfortable. I'd made 2 $10,000 purchases at least already. So I feel like it made me more ready to actually go ahead and do that. So to sum all that up, I dollar cost averaged $10,000 a month up until March, and then I finished it off with about $25,000 or so in March. Now at that point, I was also able to max out my TFSA. Now the TFSA is a tax advantaged account, meaning that it has tax benefits. So with that, there's a max cap, so total contribution limit that you can add into the account. Now in 2024, that max cap for me was $69,500. So with that $50,000 reinvested in my TFSA, plus my $2,000 monthly investment contribution for 3 months, plus some of the year-end bonus that Dennis and I paid ourselves out at the end of the last year, so in 2023, I was able to actually max out my TFSA. So what that means is that by the end of March, I'd contributed $69,500 into my TFSA, and I'd used that money to purchase shares of XEQT. Then at that point, I didn't touch my account for the rest of the year. So over the next 9 months, if we actually pull up my Wealthsimple account and go into my TFSA, you can see that that $69,500 has turned into $84,459.77, and my Wealthsimple account showing a 22.27% return so far. Now, obviously, this money will fluctuate over time. It'll go up and down. You can actually see over the last 3 months, a year, all time, how much it's gone up and down as well. So again, it's going to change over time, but for now, I'm pretty happy with the return that I have. Now, that's not where I stopped investing. Let's move on to the next investment account. So once I maxed out my TFSA, I opened up an FHSA or a first home savings account for the very first time. Now, this account is one that you can use to save or invest money that you'll eventually use to purchase your first home, assuming that you haven't already purchased one or lived in one yet. Now, for me, this isn't a goal that's in my super short term, but I know at some point Dennis and I are going to want to purchase a home to live in, so I wanted to start investing for that goal too. Now, just like the TFSA, the FHSA is also a tax-advantaged investment account. That means that it has a max cap. In this case, it's $8,000 a year or $40,000 lifetime. So for me, I started allocating my $2,000 a month investment contribution towards this account instead in April, May, June, and July, meaning that I was able to max out my current contribution room limit of $8,000 at that point. Now, I could have chosen any investment option to invest in inside of my FHSA. I ended up going with the exact same ETF that I was buying in my TFSA, which is XEQT, but it definitely took me a lot of decision-making time, a lot of research to come to that ultimate decision. Now, the main reason for that is that with my TFSA, I'm specifically and solely investing for retirement. Obviously, retirement is going to be several decades away for me, which means that my money is going to be invested for a very long period of time. And that means that I have time for my money to recover and ride the ups and downs that happen with the stock market. And because of that, I have the option of being more risky with my investments. That's the whole reason why I chose an all equity ETF like XEQT. So what that means is that it's made up of 100% stocks. Now, it is still globally diversified, but it's a little bit more risky than having other investment options in there. Now, with my FHSA, on the other hand, I in theory could be trying to save up this money to buy a home within a very short period of time. I feel like that happens to a lot of people too, right? They decide they want to buy a house, they save up, and they were buying one within a couple of years potentially. Now, in my case, that's not the plan. Dennis and I actually don't plan on purchasing a home for us to live in, at least specifically for at least 5 years, if not potentially longer. So I decided that that meant that I wanted to aim for growth inside of my FHSA, at least for now. So after really thinking it through and looking at all my options, I decided to stick with XEQT. Now again, it's growth focused, but it's still diversified, so I'm comfortable investing in it inside of my FHSA for now. And then as I get closer to actually wanting to purchase a home, as those plans get put into place, then I'll reevaluate that. Now, if we actually pull up my FHSA investment portfolio, I can tell you that it had $8,000 in the account by July, and right now it's currently sitting at $9,229.77, and my Wealthsimple portfolio, or my Wealthsimple app, is telling me that that's a 15.37% return. Again, like I said, could fluctuate over time. You can see right here that it's been fluctuating so far this year, but very happy obviously with that return so far. Now, that's still not where I stopped investing either, so let's move on to the next investment account. So after maxing out my TFSA and FHSA, I decided to open up an RRSP, or a registered retirement savings plan, next. Now, the RRSP is meant to invest for retirement, so just like my TFSA, I'm also using my RRSP to invest for retirement, which is several decades away. Now, the RRSP is also a tax-advantaged account, but its max cap, or total contribution room limit, is calculated a little bit differently. Instead, it's based on a percentage of your income earned, so it's very personal to you. Now, I knew that I wouldn't actually max out this account last year, but I was able to contribute $2,000 a month from August to December. And then on top of that, I also, when I first opened up the account, added in $32,000. Now, that came from a mix of an inheritance I received last year, and also some more of the year-end bonus that Dennis and I had paid ourselves out from 2023. Some of that money had still just been sitting in a high interest savings account, so I included that into my RRSP. Now, the big question here is, what ETF did I decide to purchase inside of my RRSP? Well, I actually did switch things up, and I decided not to invest in XEQT inside of my RRSP. Now, the only real reason for this is that I was personally starting to feel like XEQT had a little bit too high of a percentage in Canadian investments, again, for my personal preference. Now, keep in mind, as I talk about this in this section, this is very specific to me and how I feel on this. XEQT is designed to be an all-in-one ETF that you can hold across multiple or all of your investment accounts, but I'm going to explain a little bit more about what I felt like. Now, to break that down in a little bit more detail, XEQT is made up of about 47% stocks in the US market, 25% stocks in the Canadian market, 22% stocks in the developed market, and then 5% stocks in the emerging market. So that's 25% in Canadian stocks, but Canada only actually makes up about 2 to 3% of the global stock market. So if you were to compare every single country against each other, that's how much Canada would make up, which means that it's pretty highly overweighted in XEQT. Now, like I said before, this isn't that big of a deal, and you don't have to do anything about this at all. I just personally decided that I wanted to reduce my Canadian market exposure a bit and increase my US market exposure a little bit within my TFSA and RRSP specifically, so across my overall stock market investment portfolio for my retirement savings. So in order to do this, I decided to purchase an ETF called VXC inside of my RRSP instead. Now, VXC is another all-in-one ETF, so an ETF made up of multiple other ETFs, but its breakdown is about 65% stocks in the US market and 35% stocks in the developed and emerging markets. There's actually no Canadian equities in this ETF. It's literally called a global excluding Canada ETF. So it basically does the job of reducing my Canadian exposure and increasing my US exposure. So after doing all this research and figuring that out, I decided to stick with investing in XEQT within my TFSA and my FHSA, and then move forward with buying VXC within inside of my RRSP. Now, we'll see what I end up changing up in the future. It definitely could change, but for now, that's my plan, and it's what I'm continuing to stick with. Okay, so if we pull up my Wealthsimple app and go to my RRSP specifically, I can tell you that I've contributed $42,000 to my RRSP by December, and right now it's sitting at $46,464.75, and my Wealthsimple portfolio is also showing me a 10.63% return so far. Obviously, this account contributions have been more recent, and you can see, again, like my other two investment accounts, it's gone up and down throughout the year, and it could continue to change and will continue to change over time. But again, I'm happy to see my money up so far. So that's a wrap on my Wealthsimple trade portfolio results after 1 year. It's definitely really exciting to have 1 full year complete with my new investment strategy, and I'm really excited to see how things change, what everything's looking like after 2 years is done. So make sure you subscribe down below so that you're here for next year's video too. I also really want to know how your investments have been doing, so make sure you let me know in the comments below. And then after this, make sure you check out this YouTube video next, and we'll be back next week with a new video.